Good day. Today, we are looking at a case study of a hedge fund called Amaranth LLC who lost $6 billion on a natural gas future bet gone wrong. Firstly, we begin with what happened to the organizations involved. Amaranth LLC got margin called and had their position liquidated and had to declare bankruptcy. JP Morgan Chase and Goldman Sachs, the two main counterparties of the trade, had to write off loans provided to Amaranth, and Goldman Sachs reportedly lost $1 billion in this trade. Pension funds such as the San Diego County Employees Association and Teachers Retirement System of Louisiana lost $85 and $45 million respectively. Another hedge fund named Citadel LLC managed to buy Amaranth Energy position and assets for a cheap price due to their bankruptcy.
So which type of derivative products were used and how did they increase the risk? The derivative products used by Brian Hunter was natural gas futures and options. Traders are allowed to take on margin, in which case Brian Hunter took on a 20% margin, which results in a 5 times of leverage. This means that 1% change in security price results in 5% change in his portfolio's profit and loss. By trading options, traders are only required to pay an initial premium to have the right, but not the obligation to buy or sell an underlying security, which for Brian Hunter's case, it was natural gas at the strike price before or on the expiration date. The maximum loss of an option is the premium paid, and the potential profit is unlimited, depending on an option's price before expiry. In which case, price went against his trade, so he lost all the premiums paid for the options. Why did risk management procedure not work in this failure? Brian Hunter bet 50% of his firm's assets under management on a single trade. By using bear calendar spread strategy, he bought long March expiration contracts while shorting April expiration contracts, expecting the price of natural gas to increase. By betting on the same trade every year with no change in strategy despite the growing fund size and no risk management in place, he took on high leverage, which resulted in small changes in price against his speculative trade to wipe out his firm's assets.
What lessons can be learned by the institution? It's tough to list specific lessons after a huge crisis like this because some lessons may be specific to this case and not useful or even detrimental to other situations. However, one of the more important things we can learn from this is the diversification of risk capital. Brian Hunter used more than half of the firm's capital on one trade. If they had diversified their capital in more trades or even multiple traders, the firm's solvency wouldn't have been at risk on a single trade. There is also a need for transparency in the US markets, as Amaranth's failure to disclose its large natural gas positions and trading strategies made it difficult for investors and regulators to assess the fund's risk exposures. Amaranth's large positions in natural gas futures and derivatives also exposed the fund to significant risks.
If we were present during Amaranth LLC's very risky trade, we would have done 5 things. Firstly, we would have the trade spread between more traders. Secondly, we would limit trading to 2% of total managed assets maximum per trade. Next, we would diversify risk by investing in other sectors of the market. Fourth, we would actually keep cash of 15% of the total managed assets to ensure that we will not get margin call. And finally, other than just using futures, we will also use options to hedge positions on assets that we already hold. Thank you for listening to our presentation on Amaranth LLC and how we would have done things differently compared to the organization. We hope that you have learned something from this presentation. Thank you.